As suspected, tech earnings were largely outstanding, and the market's negativity towards tech shows a disconnect from reality. Tech is deflationary. However, it is actually a growth engine in all economic conditions. This week, Doug Merritt, former CEO of Splunk, joins the show to talk about earnings, tech, growth, and even a little bit of Web3 and crypto. So strap in for another dive into the tech deep end right here on Making Markets.
This is the Making Markets podcast, brought to you by Futurum Research. We bring you top executives from the world's most exciting technology companies, bridging the gap between strategy, markets, innovation, and the companies featured on the show. The Making Markets podcast is for information and entertainment purposes only. Please do not take anything reflected in this show as investment advice. Now, your host, Principal Analyst and founding partner of Futurum Research, Daniel Newman.
Hey everybody, welcome back to another edition of Making Markets. Excited to be joined here today by my friend, former CEO of Splunk, Mr. Doug Merritt. Doug, welcome aboard.
Thank you. Nice to see you. Thanks for having me.
It is nice to see you. I meant to have you on when you were running the show over at Splunk, and you and I have done a bunch of these kinds of one-on-ones, but different platforms, different show, different topics. You keynoted our 6.5 Summit a couple times, and we super grateful for that. And the world's looking a little bit different for you right now. So what's going on?
Definitely looking different. 8 years of driving Splunk, and as the board and I were talking about me moving on, my immediate response was, hey, not a bad idea, because I cannot think of a single day in 8 years where I woke up and thought, what am I doing today? Let me just relax and kick back and not worry about something. So it's actually nice to not have that wake up at 2 a.m. every single night with some worry when you're a senior exec or CEO of a company, any company, and certainly a company like Splunk. There is not a day that goes by where you don't have something, an HR issue, a product issue, a customer issue, an opportunity, and that keeps you up at night. So it's just nice to get a little bit of downtime. And I'm really back into heavy learning mode, which I'm super excited about. Another thing that a lot of people don't realize is, given the operational intensity of running any company and then going through a transformation like Splunk was going through, I was myopically focused on how to transform this company and operate this company. I know a lot about the data space and the cyber space, and those were two of the key areas that we're focused on. But I have not had that much time to actually sit back and reflect. The things that I used to do all the time, just meet with interesting people, just to have a coffee and learn. Get onto a website and download a product and play with it. Listen to your podcast and other awesome people as they're talking about interesting trends in the market. So it's been great, and starting actually beginning to get thoughtful about maybe I should step on a couple boards and advise a couple of CEOs. So it's been a really interesting and refreshing 5, 6, 7 weeks since mid-November, the first month and a half or so, helping with the transition and spending a ton of time at Splunk. Now it's moderate time, so I get some Doug time for a while, which has been good.
All I could think about as you were saying that is the luxury of choice. And then I thought about what doesn't keep a CEO up at night. And, as someone who runs a growing private company that not nearly at the same scale as what you were doing at Splunk, I can think of 1,000 things that keep me up at night. And the luxury of choice of being able to pick a few boards, pick a few projects, having had a lot of success, hopefully accumulating a little bit of, I'll call it flexibility rather than wealth. You've accumulated choice of what you might do next. And you're absolutely right, though. You definitely get into like this lane where you're thinking about what you have to think about. And if you look across the sphere of tech, because I have been lucky enough to be one of those people, we've had lunch. We're going to do that again next week. And just talking about things, you talk about, what's going on in DeFi, what's going on in crypto, what's going on in growth. And so, I'll put it this way, a lot of people probably look at an announcement and what happened in your exit at Splunk, and they might try to find the negative in it. But, I look at it as something to celebrate. You had a great 8-year run The market is in a very interesting spot right now. It might not be the worst time to not have to swim and navigate those waters. You've got people that are carrying the ship forward, and of course you're going to root for it, and you probably have some financial benefit if they keep crushing it for you. But overall, I love the fact that you're going to have a moment here to pivot and do something different.
Yeah, the timing does seem very opportune right now, honestly. And you're right. I mean, if I go back to when I entered, we were $300 million in perpetual license revenue, which is roughly the equivalent of $100 million of annual recurring revenue if we had that component when I joined. And I exited at almost 3 billion. We're 2.92 billion at the end of Q3. So of ARR, of annual recurring revenue. So to be with the company over just under 8 years and take it from 100 million to 3 billion, unbelievable opportunity. I could not be more grateful and more honored to have been part of that journey. And I think there's still a ton of growth in front of Splunk. And yes, I do have financial interests. I'm a big shareholder. I love the company and root for the company. But I do think we all knew that the valuations and the multiples that we're looking at were not long-term sustainable. And it had nothing, I'm not going to call it a bubble, or we've just seen cycles where 5x is a norm on a high growth company, up to 120, 140 was what we were dealing with. And it always is somewhere in between those two. Right? It's never as conservative as down markets, and never as euphoric as the up markets. So we knew that compression was going to come. And it's always hard to go through that change. But the good part about this cycle that I can see is there's a ton of unbelievably awesome companies out there. They are real businesses. They're 100 million plus in ARR, $500 million in ARR, and they're in annual recurring revenue. They're growing at 30, 50, 80, 100%. So those are real businesses with cash flow positivity, and the valuations just becoming more normal. And I think that's a great opportunity for the teams that are there. And when you look at the private markets that eventually will follow public markets, they almost always do, there's going to be a ton of opportunity to be thoughtful about acquisitions and about combinations. And we've all seen that there are probably a lot of companies that exist as independent that probably are features, which always happens in markets. And now they get to be part of a actual product portfolio that's not just a set of features. So I'm excited to get some free time personally, but then also given what's going on with the industry right now, because I view the next 5 years, irrespective of valuations, as unbelievably exciting. I still think we're in the first, second, maybe third inning of a nine inning or more if we go into overtime game here, and tech has got so much more run in front of it.
Yeah, it's a really exciting time to be in tech. I love what you kind of said about the private public. Cathie Wood is pretty unpopular right now, especially for anybody who invested in her ETFs. It's been pretty amazing to watch funds that are diversified fall 50%, but that's been the recent trend with growth. And the fact of the matter is the weighted indices are a complete misrepresentation of what the market dynamics actually look like right now. I heard rumors somewhere between 40 and 50% of the NASDAQ are now down over 50% off their highs. Now, there's a lot of things that can be at fault for that. When I called you up to come on the show, besides the fact that I know you had a little more time now than you had when you were at Splunk, when I was trying to get you on the show. Also, one of the things that I like is that right now you have a little bit more of the ability to have an unfiltered view. Get a CEO, a former CEO at the moment, to give a little more of that unfiltered view. Because my recent guests, some really, really sharp guys. I had Honeywell's Darius Adamczyk. I had Qualcomm's Cristiano Amon. I had Antonio Lucio from HP. I mean, these are brilliant guys, but they're running companies, and there's always a framework. They can only say so much about things like this. But right now, we're in this really interesting market dynamic. We are in a situation where growth has been slaughtered effectively. Big tech is starting to see some legitimate pullbacks, Doug. I wrote an article today in Market Watch, and I wrote it because, partially you could say it was therapy. And the header was technology companies are outperforming expectation as the Fed lowers the boom. And I was just looking at this week. Okay, so I'll just start off here because I'm framing the question. Netflix is not a FANG company. It's not even really a growth company. It was a convenient N in a word that would have not worked very well if you took it out. Let's just call it that. Okay. But the companies we're starting to see a report this week are real tech companies, real enterprise and somewhat in consumer. Now, Apple's actually reporting as we speak. I might see if I can pull that up. We could talk about it later. But we had IBM go Monday. IBM has been a monolith that has a hard time growing throughout the growth boom. And guess what? They shedded off some big overhead in their managed business, the Kyndryl GTS, and now they're growing. It only took a quarter. They're growing, and they're growing in cloud, hybrid cloud, data automation. Tuesday, Microsoft reported, and to nobody's surprise, had a killer quarter, strong guidance. So, and that was one of the things I said, Doug. I said revenues and earnings probably will be good because a lot of the shift happened about Thanksgiving forward in terms of sentiment started to shift. I said, but the guidance, everyone's going to be like, well, are these companies going to start becoming a little bit more cautious? Not Microsoft. Yesterday, Intel, nobody thought Intel was going to do well. Intel did extremely well, record revenues, slight margin compression with their new process. But, I guess my kind of point is big companies doing really well. Have we gotten out over our skis? Is growth going to be this bad, or are we just normalizing? I mean, what do you think the outlook is for big tech and growth?
So first of all, Kathy and her team, super thoughtful, intelligent people. I've loved interacting with them, and they've got a very defined position, and that position is unpopular with sentiment right now. So of course they're going to see the outcome, but as you were leading into, I think the fundamentals are legitimate. They're Warren Buffett, I think, is at least credited with saying in the short term, the market is a voting machine. In the long term, it's a weighing machine. We've all got to focus on the weighing. And when I look out over the next 3 to 5 years, it's not even remotely surprising that Microsoft, Intel, I'm curious to see Apple, but that over.
Hey, hold on. I'll give it to you because I just found it. You want it?
Yeah.
All right. Earnings were $2.10 versus $1.89 estimated. So they beat pretty significantly on the bottom line. Revenue came in at 123.9 versus 118. So Apple, I would say that's a near blowout for Apple, which is very closely tracked. It's not easy for them to blow them out. So go ahead. Sorry. So there you go. You got them all.
That makes sense to me because the underlying fundamentals that we all get tired of hearing about, that the world is still going through, and at the very beginning, sadly, interestingly, digital transformation. It's real. There is significant productivity and agility that comes to an organization as they digitize more business processes. To digitize business processes, you need to buy a bunch of tooling, you need to buy a bunch of apps, you need to consume a bunch of infrastructure. That infrastructure means you're consuming a bunch of silicon, compute, a bunch of networking products, a bunch of storage, like that. Are interest rates going up more? Yeah, I think so. I think we'll all agree on that. Is inflation real? Probably. It seems like it. Through that, do companies still have to find a way to grow? Yes. Are consumers going to still have some purchasing? Absolutely. And every one of those organizations need to find efficiencies and effectiveness increases? Yes, they will. And I think the tech industry will continue to be the driver, as it has for the past couple of decades, of those trends. What has changed is the over-optimism and potentially, mostly it happens with capital, but potentially the overbidding on the promise of some of these companies. But again, as we started with, so many of these organizations that have recently gone public and have seen these astronomical market caps are fundamentally good companies. They are cash flow positive. They are real revenues. Once you get above $100, $200, $300 million in annual recurring revenue, that's real. That's a legitimate company. Much less, these mega companies like Microsoft, Intel, Apple's we just talked about. So I am and will remain a super strong bull on the tech industry and how much more potential it has, because I still think the reach is pretty limited versus what is possible. And in many ways, I'm actually happy that there's a little bit more of a realistic perspective on how these companies should be valued, so that they don't have 5 years to grow into their valuation, which is what I think we were seeing with some of the multiples that are just like, at least for now, are behind us. We'll see what.
Yeah, I mean, some of the rev multiples were off the charts big. You had some companies that you certainly saw they pulled a lot of growth forward. Companies like Zoom, where Eric Yuan's a great CEO.
Yes.
He's proven, and that company is going to be fine no matter what the exit is, whether it's they build a platform and grow, or they get acquired by AWS and become the team's competitor. I don't know, but the point is whatever happens there, it's a good company. The fact that it was at 550 or so and now is at 150 is almost unbelievable. But the what you're kind of saying is it probably never should have gotten to 550, and 150 is probably a really fair price because you're still talking about something like 40 times forward earnings. So
Yeah. Yeah.
it is a very high price considering what Microsoft trades around 30, Intel trades at 10. I think Amazon's one of the ones that is still pretty high at a 50, but like other than like the AMDs and NVIDIAs that have been out closer to 100, which is just crazy.
Yeah.
At some point it had to normalize, but now now when you get this compression, there's runway for growth again, which,
Right.
growth in the value, and these companies kind of get out from underneath that pressure to be able to deliver numbers that warrant these prices. But I think for a lot of investors, it's just really hard to palate, like, good Lord, what happened to these valuations?
Yeah, I think, and both you and I are investors in companies.
We are.
We get to experience this, but my fundamentals on these companies, I like the companies I've invested in. I believe in them. I usually use their products either on the corporate side or on the personal side, and I don't think there's anything wrong. I own a number of Peloton devices. It's a great company, and you're right. They pulled growth forward, but probably by 4 or 5 years, which was awesome. But I don't see their subscriber count falling off. My usage is not lower. Will it be lower as we all go back to gyms? Maybe a little bit, but not much. I'm not canceling my subscription. So I just think we all need to take a deep breath, try and focus on the weighing machine aspects. And the hard part is for any people that need cash immediately. That's always a problem, which is why we all get that sage advice of, hey, only invest in high risk assets, that which you don't need access to and you can afford to lose.
Yeah.
Almost always is a patience game.
It is. And over time, I mean, I cited this in my Market Watch piece. It was, I'm sure I'll get ripped a lot by people who are mad right now. But I said, the so-called tech wreck makes for good headlines, but perhaps this is the moment to remind investors that tech will be okay. The NASDAQ has had 66 corrections since 1971. But is still up nearly 7,400% over the last 40 years. So if you can be patient, if you can wait, I say this to all the people, you might have been the one that bought Amazon at 100, sold it at 10, and then said, God, what would your life be like if you'd have just held on? Now that kind of creates a lot of jokes about the hodlers. Yep. And that creates a lot of jokes about the diamond hands and all the people. I've seen some funny memes lately about the, hey, diamond hands, welcome back. It's a picture of some people going back to work at Wendy's. I mean, look, these are a little bit meager times. I said last week, I recorded my show. I was wearing a black shirt and a black vest. I said, I'm dressed in all black because it feels like a funeral. I said, but the fact is we will be okay. And you said something earlier, kind of for our last topic. I want to go into crypto and Web3 with you just a little bit. But before I say that, you said something I think is worth reiterating. Tech is deflationary. I think that's actually what you were saying. And that, by the way, is sort of Kathy's thesis too, is that the fact is whether you're in the growth phase in the economy where tech booms because everything's booming, but actually when the economy slows, companies look at, whether it's your old company at Splunk, I wrote a really positive earnings beat on ServiceNow yesterday. I mean, talk about workflow automation. Yep. Companies are going to say, how do I become more streamlined? How do we reduce costs? How do we become more efficient? It could be from anything from meeting customer experience goals to meeting your ESG goals. Technology is going to enable you to do it faster. It's going to enable you to do it for less money. You can do most of it operational expense wise, not CapEx now, which is very convenient for most companies from a cash flow standpoint. It's deflationary. And so while everybody's got this thesis that tech's, going to get this big growth compression on a 0.5 point or a 1% interest rate hike, I would argue that the growth will accelerate exponentially more than whatever the discount rate impacts in terms of costs.
Yeah, I mean, ultimately we sell to companies and they need to have available budget, which almost always is a percentage of their revenue. So, tech always follows the health of the global economy to an extent. However, as you just said, even in a more challenged revenue scenario, almost every organization, especially if we still face skills challenges, cross-border crossing challenges, and labor shortages of any type, tech becomes instrumental, non-negotiable to drive our organizations forward. We're going to continue to have to serve customers better. We're going to continue to have to innovate our portfolios. And we're going to have to continue to find ways to streamline our operations. And you can't do that without technology and the applications and tools that surround it. So I just I don't unless we stop unless a series of global EMP strikes takes out the entire backbone of technology and we go back to the dark ages, there's companies are on this wheel that they can't jump off of continuous improvement. And I believe technology is the backbone of that.
Yeah, you and I are on the same page. Again, some of these opinions may be unpopular right now with people who've been margin called and liquidated and feel like doom is here. But I think, that is really what's going on, is that tech will continue to be the fundamental and foundational element of what will actually carry us forward into the next wave of significant growth.
Yeah.
And by the way, that next wave to me is interesting and just kind of, let's just at a very high level. I know you're not a Web3 expert. In fact, when you and I sat down and chatted, that's one of the things we said is we're both really digging in here. We're learning, we're interested. But, whether that's crypto, whether that's some of the projects built on blockchain and some of the different coins and altcoins, whether that's, the metaverse, what are your sort of initial impressions in this space? Are you going to be investing some serious time? What are you looking at around Web3 and the metaverse?
Yeah, and my newly found freer time, that's definitely a big chunk of my focus right now is trying to get much more deeply current, not superficially current on Web3 and blockchain. Any of us in the tech industry have been reading about it for the past 5, 6, 7 years, but that's different than, again, having your own wallet and transacting a couple NFTs and holding a broad portfolio of different well-known and not well-known cryptocurrencies, and just trying to listening to, again, a series of podcasts, following the investments at Andreessen Horowitz, who's done an incredible job in the crypto space. So that's where I've been spending most of my time. I am very enthusiastic about what the promise of Web 3.0 brings. Everyone wants to believe that every one of these shifts are brand new. And what older folks like you and I have found is every one of these shifts just builds off of the past. We've been dealing with distributed data structures since the 60s. That is not a new concept. We've been dealing with tele everything since the 70s. That's not a new concept. Virtual worlds have been around for close to 30 years. Is the quality better? Yeah. But Neil Stephenson did a great job in the early 1990s with Snow Crash, painting what this metaverse world might look like. So a lot like what happened with the pandemic, we're getting a lot of interesting acceleration around some of these concepts, but the laws of physics still apply. And as you and I were talking about at lunch the other day, I'm still thrashing through trying to figure out, okay, I get the promise of Web3 is fantastic, constantly available, fully distributed and replicated data in a transparent and immutable basis. Like, who does not want that? That is what we've been working on, again, for 60, 70, 80 years of what we're doing in tech.
I'd love to see all those dark pool trades in somewhere.
Transparency is good. But there's a cost for that, right? And we can see the cost. And there's got to be, if you want a true peer-based network, then there's got to be different mechanisms to create that transparency and that security and that immutability. And which use cases are justify that cost? Who's willing to pay for it? And I think we're way back at that early stage and we've all been hearing property title, and inefficiencies in the insurance industry and governmental services, key for blockchain. Yep, it is. Where are the replicable services and repeatable companies that are providing those? Well, they're not quite there yet. But Web 1 and Web 2 companies in the late 90s and early 2000s weren't there either. That doesn't mean the internet didn't become what it is now that we're leveraging. It just means there's time to build out both let the technology grow up, let the costs become less onerous, because they always do with Moore's law and all the derivatives, and let the vendors, the proponents, catch up to be able to provide the services. But definitely an area that I am super fascinated by. as you get closer to it, I think most of us that have been in the tech world, I get more and more intrigued. I can see why they call it the rabbit hole, because you begin to play, you just want to go deeper and deeper. So I'm excited.
Yeah, it's you make a lot of great points. The speed of change keeps getting faster. Makes me think about, for a lot of people that are trying to figure out how to invest or what their strategy is around crypto, is it makes there's a quote in The Big Short that's something along the lines of I might be early, but I'm not wrong. And then the guy goes, "It's the same thing. It's the same thing." And the fact is the first dot bomb, the bubble was all about the fact that it wasn't dot bomb wasn't real. It was all going to be real. It was it was too soon.
Timing.
We all got way out in front of ourselves, and there's a little bit, you could see a little bit of that with, you can call it, like you said, maybe it's a bubble, maybe it's just inflated valuations, but with crypto, especially some of these alt projects. But one of the ways I've thought about it, Doug, because I've tried to simplify this too, because I'm a little bit of, I can be a little bit linear in thinking at times. I'm like, you've got a little bit of kind of an IaaS PaaS SaaS thing going on with crypto. You've got your projects that are infrastructure, you got the ETHs, and you've got the Solanas, and then you've got your platforms, the projects that are specific for IoT or for 5G or for social media networks in the blockchain, and you've got your actual applications, people building games on the blockchain, and and they're selling these projects. But it's basically, they're like projects, and you kind of made that comment, they're kind of like features in a lot of cases. They're not really companies yet. And unfortunately for most of us, we got to read all these white papers, because that's still we got the coolest emerging future technology. But the way we decide about investing is you read a 20-page long white paper. It's like, how backwards is that process? But what I will say is that you are right, that this is very real. It's tangible. It's coming. This level of visibility and transparency, I believe most of society wants, but it's a little bit like privacy, where there's always trade-offs, meaning that in order to get it, you're going to have a certain amount of trade-off in order to get it. And so we're all still sort of navigating how much we're willing to trade off, how much transparency we're willing to give, how much risk we're willing to put in moving our currency or moving the way money flows into a sort of an unknown, unregulated, soon to possibly be regulated set of digital assets, stores of value. So there's a lot going on there. Now, one quick question to kind of wrap this up, and you can give me one or two or three. But when it comes to Web3 or Metaverse, are there any companies kind of well known or projects that are really interesting to you right now?
Most of my time has been down at that 1.5 and 2 level. Starting with Bitcoin and the proof of work basis, but then jumping into Ethereum and Solana. And the way that I tend to learn is I've got to understand at a reasonably detailed level. I'm an experiential learner, and I'm a competency based leader. If I don't understand something, it's really hard for me to be excited about it. So I am way down at that level 1, 1.5, and a little bit of the 2 on the way that at least the descriptions of the different blockchain layers exist. And I mean, the fascinating thing is, as you're saying, it's so early. It is so early. It reminds me of the early 90s when I was getting started in tech and all the early internet companies. We forgot 99% of names, the companies that were once hot beyond belief.
Lycos and Excite and Jeeves and I don't know, all these cool companies. Even AOL has been forgotten at this point.
Especially by today's generation. But they were absolutely foundational to get us there. And for a moment in time, they were worth a lot. And they, but it's just a stair step of experimentation and build until there's enough repeatability and understandability and gravitas and users, and to actually make something as prolific as it needs to be. And cryptocurrencies, certainly, the major cryptos are at that point of gravitas. But I think the bulk of the rest of the promise of blockchain and Web3 is still at an earlier stage, which for people like to experiment with that startup world. And I know I just got done with a big $3 billion company leadership role, but I was a founder twice. The huge chunk of my early life was in zero revenue to under $10 million revenue companies. So it's an exciting area of the landscape. And you just have to be willing to go through to understand the pains of startup and the stops and starts that come with that.
Yeah, you've experienced a whole gulf. One thing I'll kind of end here, Doug, but is I do think some of the big mega tech companies are going to lead in this Web3. You know, this year I did a Market Watch op-ed on the tech trends and the companies that are going to be worth watching. You know, and in Metaverse, for instance, it's going to be Microsoft, it's going to be NVIDIA, it's going to be Roblox,
Really,
it's going to be,
yep.
you know, Meta maybe, but you know, I'm least bullish about them, but I just think it's because I don't particularly like the company. So it's probably not to do with they'll probably be fine. I just don't particularly care for some of the decision making they do. But those are going to be the companies that, for the average person that wants exposure, that they're going to be able to get exposed to it through some very, very safe, robust, well-led companies like those that I just named. Now, of course, I say this in the beginning, I say it at the end, and I'll just remind everyone now, this isn't investment advice. It's just two guys having a conversation, just sharing what we're thinking about. But Doug Merritt, it's been a pleasure working with you at your time at Splunk. It's going to be a pleasure continuing talking. Thank you so much for joining me here on Making Markets.
Vice versa, Daniel. Thanks for having me on, and I'll see you in a few days.
Thank you for tuning in to Making Markets. Enjoy what you heard? Please subscribe to get every episode on your favorite podcast platform. You can also watch us on the web at futurumresearch.com/makingmarkets. Until next time, this is Making Markets, your essential show for market news, analysis, and commentary on today's most innovative tech companies.